In any market that actually functions, a business has two instincts operating at the same time. It wants to buy and it wants to sell. That balance is what keeps commerce alive. Goods move, money moves, inventory clears. Nobody needs to think about it. The system does the thinking for them, but on Thursday, January 22nd, 2026, that balance did not bend. It snapped. What failed was not confidence. What failed was not demand. What failed was not supply. What failed was the mechanism that connects all three. Early that morning, a document circulated quietly through the professional side of the precious metals industry. It did not come from a regulator. It was not issued by a central bank. It was not written in dramatic language. It was simply a standard trade sheet from one of the largest wholesale distributors in the United States. These are not retail brands. These are not online storefronts. These companies sit in the narrow space between the U.S. Mint and the local coin shop. They are authorized purchasers. They are clearing hubs. They are the pipes that move metal from source to street. And the sheet showed something that should not exist in a functioning market. On the sell side, every product line was gone. Silver Eagles sold out. Maple Leaf sold out. 100-ounce bars sold out. That part was not surprising. The shortage has been visible for months. The drain toward Asia has been documented. The public demand surge is measurable. But the other side of the sheet did not behave the way economics says it should. The buy side was empty. Multiple major products were listed with the same two words: no bid. Translated into plain language, this does not mean a low offer. It does not mean price discovery. It means refusal. It means that if a seller contacted this wholesaler with 1,000 ounces of silver, the conversation would end immediately. No negotiation, no counter, no transaction. This is where logic breaks down. Silver is trading at $95 an ounce. Public demand is up roughly 400%. Industrial demand from manufacturers like Samsung and Tesla has not slowed. Shanghai prices are printing above $100. Under every normal rule of supply and demand, wholesalers should be competing aggressively for metal. They should be raising bids, not erasing them. And yet the largest pipelines in the United States market stepped away. The reason has nothing to do with desire. It has everything to do with capital. What we are witnessing is a liquidity failure at the wholesale level. These firms are not insolvent in the way people imagine bankruptcy. They are not empty. They are not irrelevant. They are asset-heavy and cash-starved at the same time. They own metal, at least on paper. They do not have the dollars required to operate. To understand how this happens, you have to understand what a wholesaler actually is. This is not a speculative business. It is a throughput business. Margins are thin. Volume is everything. Metal comes in, metal goes out. The profit exists in movement, not direction. To keep that movement alive, wholesalers depend on credit. They borrow to acquire inventory. They hedge price risk. They ship product. When the product sells, the loan is repaid. That cycle has existed for decades. But on this day, the cycle broke. The credit lines were already stretched. Margin obligations were already rising, and the banks that provide the oxygen to the system shut the valve. No bid is not a pricing decision. It is a medical emergency. When blood stops flowing to an organ, the problem is not the organ. It is the circulation. And once circulation stops, function follows quickly. If a wholesaler cannot borrow, they cannot buy. It does not matter how many customers are waiting. It does not matter how high the demand climbs. Without the ability to write checks, transactions simply do not occur. That is how a market freezes. Now picture this from the ground level. A local coin shop owner opens his doors. Customers are lined up asking for silver. He calls his wholesaler. There is nothing available. Then a seller walks in and offers to sell metal. Under normal conditions, this would be ideal. Buy locally, sell upstream, refill cash, but upstream no longer exists. If the wholesaler says no bid, the dealer cannot recycle inventory. Cash gets trapped in metal, and cash is what keeps the lights on. Without cash flow, even strong businesses begin to suffocate. This is not a shortage event. This is a throughput failure. The price did not break the market because it went down. It broke the market because it moved faster than the financial infrastructure could survive. At $95, the middle layer collapsed. The internal description is precise. This is not due to a lack of demand for silver, but due to a lack of capital at the largest wholesalers and brokerages in the country. That distinction matters, because the public story will be wrong. There will be voices claiming interest faded, that sentiment shifted, that the move exhausted itself. None of that aligns with the data. Demand remains aggressive. Inventory remains tight. What vanished was the bridge between buyer and seller. For decades, centralized aggregators handled that bridge. Large firms coordinated flow, pricing, hedging, and settlement. They were hubs. But hubs only work when credit is stable and assumptions hold. Those assumptions no longer hold. The wholesale industry tied its survival to two beliefs: that the dollar would remain liquid and that silver would behave like a predictable commodity. Both beliefs failed at the same time. Silver became volatile. Dollar liquidity retreated from real assets. The result is what we are seeing now. This no-bid condition is not an anomaly. It is an early symptom of a broader monetary disorder within a specific sector. In inflationary environments, goods do not vanish because nobody wants them. They vanish because pricing stops making sense inside the currency used to buy them. In this case, financing costs overtook margins. Transactions stopped because the math stopped working. For observers, this moment serves two purposes. It confirms the physical shortage is real. If silver were abundant, wholesalers would not be exhausting credit lines fighting to secure it. And it introduces a new risk that most people did not model. Liquidity risk. An asset can be extremely valuable and still be difficult to convert through official channels. That is not theory. It is happening. As centralized pathways close, transactions drift outward. Private exchanges appear. Street-level trades increase. These are not recorded on trade sheets. They do not clear through institutions. They exist outside the system. When official markets close quietly, unofficial markets open naturally. And that is where this story goes next. Part 2. How the hedge turned into a trap. From the outside, what happened next looks impossible. Silver did not collapse. It did not drift sideways. It did not slowly grind higher. It went vertical. From roughly $25 an ounce to $95, the move was fast enough to break assumptions that had been treated as laws. And when assumptions fail inside a leveraged system, damage does not arrive gradually. It arrives all at once. This is where the story becomes counterintuitive. If you ask the average person what should happen to a silver dealer when silver nearly quadruples in price, the answer would be simple. They should be thriving. They should be flush with cash. They should be celebrating the best conditions of their professional lives. That is not what happened. Many of the firms at the center of the physical market moved from record demand directly into financial distress. Some entered restructuring. Others quietly froze operations. A few began preparing for bankruptcy protection. The question is, why? The answer sits at the intersection of risk management and leverage, in a strategy that was designed to protect the industry, but instead became the mechanism that destroyed it. That strategy is called hedging. Wholesale bullion dealers are not investors. They do not buy silver because they believe in monetary collapse or long-term appreciation. They buy silver to move it. Their profit exists in the spread, not the direction. Buy at spot +1, sell at spot +2. Repeat at scale. But there is a risk embedded in that model. Between the moment a wholesaler acquires metal from a refiner and the moment they sell it to a dealer, the price can move. If it moves down sharply, losses can exceed annual profits. To prevent that, banks require wholesalers to hedge. The instruction is simple and non-negotiable. For every ounce of physical silver acquired, an equal amount of paper silver must be sold on the futures exchange. This creates what is called a delta-neutral position. Price goes down, the physical inventory loses value, but the paper short gains. Price goes up, the physical gains, but the paper loses. In theory, the two cancel out. On paper, this looks elegant. In calm markets, it works. But calm is the hidden requirement. What hedging actually does is replace price risk with liquidity risk. And liquidity risk is far more dangerous because it operates in real time and demands cash, not explanations. As silver began its ascent, the physical inventory inside warehouses increased in value dramatically. On balance sheets, these firms looked richer than ever, but balance sheets do not pay margin calls. The short positions on the futures exchange began to bleed immediately. Every dollar increase in the silver price created a dollar loss on the hedge. Those losses were settled daily, not eventually. Not when the metal sold. Every single day, this is called variation margin. At the end of each trading session, the exchange calculates the change in price and demands payment. Cash payment, wire transfer, no delays. As silver moved from 50 to 95, these margin calls did not arrive as a single bill. They arrived as a series of escalating demands, each one larger than the last. Hundreds of millions of dollars left the wholesale sector and flowed directly into the clearing system. Where did that money come from? Not from profits, not from sales, from operating capital, from payroll accounts, from inventory budgets, from credit lines. This is the liquidity trap. The physical metal was becoming more valuable, but that value was locked inside inventory. It could not be accessed without selling the metal. Meanwhile, the paper losses were draining cash instantly. Asset rich, cash poor. This condition is survivable for a short time. It becomes fatal when prices continue rising and credit tightens simultaneously. As silver climbed higher, the margin calls grew larger. Bank accounts emptied. Credit facilities were drawn down. Eventually, limits were hit. And when there is no more cash to send, the hedge cannot remain open. This is where the paradox turns lethal. If a wholesaler closes the hedge, they are exposed to downside risk. Banks will not allow that. If they keep the hedge open, margin calls continue. There is no third option. The hedge that was meant to protect the business becomes a machine that consumes it. This is how wholesalers hedge themselves into insolvency. The irony is severe. The industry that exists to distribute silver was financially destroyed by silver becoming too valuable, too fast. By shorting the metal, wholesalers implicitly bet that silver would remain stable relative to the dollar. They assumed it would behave like an industrial input, not like a monetary instrument. That assumption failed. Silver did not act like copper or aluminum. It acted like a currency undergoing revaluation. And when a currency revalues, anyone who is structurally short that currency suffers. The scale of this problem is not small. Large wholesalers routinely hedge their entire inventory, millions of ounces, tens of millions in some cases. A firm holding 10 million ounces and hedged short 10 million ounces experiences a $700 million loss when silver rises $70. That loss does not wait. It does not negotiate. It demands cash. Very few firms have that kind of liquidity available. They rely on banks. And as those banks watched volatility explode, they pulled back. This is why the system locked up. The metal did not disappear. The mechanism that moved it imploded. The paper-silver market did not just influence price. It consumed the infrastructure that supported physical distribution. By forcing physical dealers to operate inside a derivative framework, the system guaranteed that when a true revaluation occurred, the weakest link would fail first. That weakest link was liquidity. This leaves the public in a strange position. The institutions that once provided easy entry and exit are still visible, but functionally impaired. They exist, but they cannot transact. They look alive, but they are financially immobilized. This validates a risk that was always present but rarely acknowledged. Counterparty risk does not stop at banks and exchanges. It extends to dealers when they operate under derivative constraints. If an intermediary depends on paper markets to survive, they inherit the paper market's fragility. In this environment, solvency does not come from scale or reputation. It comes from the absence of leverage. Those holding metal without debt, without hedges, without margin exposure occupy a very different position than those trying to move it professionally. The destructive hedge explains the sold-out but no-bid paradox. It explains why rising prices crippled the very industry meant to benefit from them. It explains why the paper market began cannibalizing the physical one. But the hedge alone did not finish the job. The final lock was credit, and that is where the story goes next. Part 3. The credit freeze and why the banks walked away. If the hedge was the wound that started the bleeding, credit withdrawal was the moment treatment stopped. Up to this point, the damage could still be misunderstood as a temporary imbalance. Painful, but manageable. Many businesses survive bad trades. Many industries endure volatility. What turns stress into systemic failure is not loss itself, but the sudden absence of credit. Modern markets do not run on cash. They run on confidence encoded into lending agreements. Credit is the unseen force that allows inventory to move faster than money would otherwise permit. It is the oil inside the engine. When it flows, no one notices. When it stops, everything grinds. For decades, wholesale precious metals dealers operated inside a predictable credit environment. Banks extended revolving lines that allowed firms to purchase large volumes of silver from refiners, hedge exposure, ship product to dealers, and repay loans once sales cleared. It was routine, boring even. That boredom was the signal of stability. On Thursday, January 22nd, 2026, that stability vanished. Reports began circulating quietly through the industry that major lenders were not just declining new credit requests, but actively reassessing existing facilities. Some lines were frozen, others were reduced. In a few cases, banks requested early repayment or additional collateral. From the outside, this behavior looks irrational. Demand was exploding. Inventory values were higher than ever. Why would banks retreat at the exact moment the business appeared strongest? The answer lies in how banks interpret risk. To the public, silver moving from $25 to $95 is a story of appreciation. To a bank's risk department, it is a volatility event. Risk models do not reward upside. They punish unpredictability. When price charts turn vertical, internal systems flag instability. The asset is reclassified. Lending terms change. Exposure limits tighten. What was once acceptable collateral becomes suspect. This is where the concept of a haircut becomes critical. A haircut is the discount a bank applies to collateral when calculating how much it is willing to lend. When silver was stable at $20, a bank might lend 90% of its value. At $95 with violent daily swings, that haircut widens. 50% is not unusual, sometimes less. This creates a silent squeeze. Even though a wholesaler's inventory is worth more on paper, their borrowing capacity shrinks. The same bars that once supported robust credit now support far less. Purchasing power collapses without a single ounce leaving the vault. There is also a simpler constraint that does not require any complex modeling. Credit lines have limits. Imagine a wholesaler with a $100 million facility. When silver was $25 an ounce, that line could finance roughly 4 million ounces. That volume supported the entire downstream ecosystem. Metal flowed. Dealers were supplied, recycling functioned. At $95 an ounce, that same credit line finances barely 1 million ounces. Nothing about the credit agreement changed, nothing about demand changed, but the capacity of the system fell by 75%. This is what happens when price rises faster than infrastructure. Now combine this with what we already know. Wholesalers were already sending enormous amounts of cash to the futures exchange to meet margin calls. Their credit lines were already strained. Their liquidity buffers were already thin. The moment banks tightened terms, there was no room left. This is why no bid appeared. Not because wholesalers disliked silver, because their bank dashboards read limit reached. This is how a credit freeze becomes contagious. Local coin shops depend on wholesalers as the buyer of last resort. They operate on narrow cash cycles. Buy from the public in the morning, sell upstream in the afternoon, refill cash, repeat. When the wholesaler steps away, that cycle breaks. The dealer buys silver but cannot offload it. Cash becomes metal. Metal cannot pay rent. The dealer's balance sheet may look strong, but their register goes quiet. Very quickly, the dealer stops buying. No bid spreads. What begins at the bullion bank moves to the wholesaler, then to the storefront, then to the street. Liquidity evaporates layer by layer. The velocity of silver, the speed at which it changes hands, drops sharply. Then it drops to zero. And banks do not reverse course when this happens. They do not step in to stabilize niche markets. From their perspective, reducing exposure during volatility is correct behavior. There is also a structural incentive few people mention openly. Large financial institutions maintain significant paper exposure to precious metals. A stressed physical market reduces delivery pressure. Chaos in distribution can temporarily relieve settlement stress upstream. By restricting credit, banks protect themselves. The effect on the physical market is collateral damage. This is not a conspiracy. It is alignment of incentives. The result is a strange but stable condition. Paper prices can continue printing. Futures contracts can continue settling. Headlines can continue reporting numbers. Meanwhile, the physical market remains partially paralyzed. This is how a bifurcation begins. In inflationary environments, trade does not stop because goods vanish. It stops because the mechanism of exchange fails. Pricing becomes unreliable. Financing becomes impossible. Participants step back. What we are watching is not panic. It is a stroke. The silver exists. Demand exists. But the heart of the system, the credit engine, has stopped pumping. And when circulation fails, damage spreads quietly before anyone outside the room notices. The next phase is unavoidable. Small and medium dealers cannot survive prolonged freezes. They do not have the reserves. They do not have central bank access. They are not systemically important. What follows is consolidation, closures, absorptions, a thinning of the market. The crisis does not announce itself, it leaves traces, and that brings us to the casualties. Part 4. The industry wipeout and the collapse of price discovery. Once liquidity stops moving, time becomes the enemy. Large institutions can wait. They have reserves, political access, and accounting flexibility. Small and mid-sized businesses do not. They live on flow. When flow stops, survival becomes a countdown. This is where the damage becomes visible. The precious metals industry is not dominated by banks at the retail level. It is built on thousands of independent operators, local coin shops, family-run dealers, regional wholesalers. Online businesses started decades ago and maintained through reputation rather than scale. These firms are not hedge funds. They do not have billions parked in reserve. They operate on predictable cycles, buy metal from the public, sell it upstream, lock in a narrow margin, repeat. On January 22nd, that model stopped working. When wholesalers went no bid, local dealers lost their exit. Inventory that would normally move within hours began sitting idle. Cash that would normally return by the end of the day stayed trapped inside metal. This is a silent failure mode. A dealer can look solvent while becoming insolvent. Shelves are full, vaults are heavy, but the register does not ring. Bills do not care what form assets take. Rent, utilities, payroll, insurance, security, these are denominated in dollars. Silver cannot be handed to the electric company. As days pass, choices narrow. Some dealers stop buying, others reduce hours. A few quietly close their doors without announcements. Websites remain up, but inventory does not change. Phones stop being answered. This is the casualty phase. It does not happen all at once. It happens unevenly. One shop here, one dealer there. From the outside, it looks random. From inside the system, it is patterned. Cash-rich entities survive. Leveraged entities fail. This is not moral. It is mechanical. In every financial crisis, consolidation follows. The strong absorb the remains of the weak. Market share migrates upward. Competition thins. The precious metals industry is no different. What emerges on the other side is a smaller number of very large players. They have balance sheets that can endure volatility. They have relationships that provide selective access to credit. They are considered important. For the public, this has a consequence that is often overlooked. Price discovery breaks. In a healthy market, price is negotiated. Thousands of dealers compete. Premiums stay contained. If one shop charges too much, another offers less. The spread stays narrow. When competitors disappear, that mechanism dies. Part 4. The industry wipeout and the collapse of price discovery. Once liquidity stops moving, time becomes the enemy. Large institutions can wait. They have reserves, political access, and accounting flexibility. Small and mid-sized businesses do not. They live on flow. When flow stops, survival becomes a countdown. This is where the damage becomes visible. The precious metals industry is not dominated by banks at the retail level. It is built on thousands of independent operators, local coin shops, family-run dealers, regional wholesalers. Online businesses started decades ago and maintained through reputation rather than scale. These firms are not hedge funds. They do not have billions parked in reserve. They operate on predictable cycles. Buy metal from the public, sell it upstream, lock in a narrow margin, repeat. On January 22nd, that model stopped working. When wholesalers went no bid, local dealers lost their exit. Inventory that would normally move within hours began sitting idle. Cash that would normally return by the end of the day stayed trapped inside metal. This is a silent failure mode. A dealer can look solvent while becoming insolvent. Shelves are full, vaults are heavy, but the register does not ring. Bills do not care what form assets take. Rent, utilities, payroll, insurance, security, these are denominated in dollars. Silver cannot be handed to the electric company. As days pass, choices narrow. Some dealers stop buying, others reduce hours. A few quietly close their doors without announcements. Websites remain up, but inventory does not change. Phones stop being answered. This is the casualty phase. It does not happen all at once. It happens unevenly. One shop here, one dealer there. From the outside, it looks random. From inside the system, it is patterned. Cash-rich entities survive. Leveraged entities fail. This is not moral. It is mechanical. In every financial crisis, consolidation follows. The strong absorb the remains of the weak. Market share migrates upward. Competition thins. The precious metals industry is no different. What emerges on the other side is a smaller number of very large players. They have balance sheets that can endure volatility. They have relationships that provide selective access to credit. They are considered important. For the public, this has a consequence that is often overlooked. Price discovery breaks. In a healthy market, price is negotiated. Thousands of dealers compete. Premiums stay contained. If one shop charges too much, another offers less. The spread stays narrow. When competitors disappear, that mechanism dies. The surviving dealers do not need to collude. Scarcity and reduced competition do the work automatically. Spreads widen. Buy prices fall relative to sell prices. The gap becomes the new normal. This is how a market becomes illiquid even while demand remains strong. Reports from the field already suggest street prices diverging sharply from screens, $95 on paper, $120, $130 in practice, and buyback offers lagging far below that. The bid-ask spread becomes a chasm. This is not price manipulation. It is structural friction. Dealers price in risk. Risk that wholesalers may default. Risk that credit will tighten further. Risk that inventory cannot be replaced. The premium becomes insurance. For the average participant, this makes silver feel harder to use, harder to trade, harder to liquidate through familiar channels. That perception has an unintended effect. It slows movement. When assets become difficult to trade, people stop trading them. They hold tighter. They safeguard. The velocity drops further. Silver that enters private hands stops circulating. This has consequences upstream. Recycling collapses. Secondary supply, the metal that returns to the system through households and small dealers, depends entirely on functioning buyback networks. When those networks fracture, silver does not return to refiners. It stays in drawers, safes, private storage. Mining supply remains flat, industrial demand remains high, recycling falls sharply. This is what a supply cliff looks like. Not a sudden disappearance, but a steady withdrawal from circulation. The centralized market structure was built for stability, predictable prices, predictable credit, predictable flow. It was not designed to survive a monetary revaluation. That structure is now visibly impaired. But markets do not tolerate vacuums. When formal pathways fail, informal ones appear. Trade does not stop. It reroutes.